In the evolving world of finance, one of the most significant revolutions happening right now isn't unfolding in the grand boardrooms of Wall Street, but in the digital ecosystems powered by blockchain. Stablecoins, cryptocurrencies pegged to real-world assets like the US dollar, are quietly transforming the way money moves, how economies operate, and who gets access to financial power. For years, traditional finance regarded crypto with skepticism, dismissing it as a passing trend. But as we step deeper into 2025, stablecoins have emerged as a formidable force, challenging the very core of legacy banking and monetary systems. The original promise of cryptocurrency was decentralization, removing banks, middlemen, and borders from the equation. Yet volatility remained a barrier. While Bitcoin offered a decentralized store of value, it couldn't be used for everyday transactions due to price swings. That's where stablecoins entered the picture. By maintaining a consistent value, usually pegged 1.1 with fiat currencies like the dollar, stablecoins merged the best of both worlds: the stability of traditional currencies with the speed, accessibility, and innovation of crypto networks. In 2025, the stablecoin landscape has matured significantly. The total market cap of stablecoins now exceeds $250 billion, with daily transaction volumes rivaling that of major payment processors like PayPal and Visa. Tether, USDT, and USD Coin, USDC, remain the dominant players. But new entrants, many backed by financial institutions and even governments, are gaining traction. The public has voted with their wallets. More people are now choosing to hold their money in stablecoins than ever before, especially in regions suffering from inflation, banking restrictions, or political instability. For many around the world, stablecoins are not just convenient, they're essential. One of the biggest shifts we've seen in 2025 is the role of stablecoins in replacing traditional savings and checking accounts. In countries like Argentina, Nigeria, and Lebanon, where local currencies have lost credibility, millions have turned to USDT or USDC as a safe haven. Unlike a traditional bank, which can freeze funds or impose withdrawal limits, stablecoins offer true financial sovereignty. All a person needs is a smartphone and internet connection. With non-custodial wallets like MetaMask or Trust Wallet, they can hold dollars in digital form, free from the control of corrupt or failing institutions. This decentralization of savings has started to scare traditional banks. After all, what happens when people no longer need a bank account to hold their money? What happens when sending $10,000 across the globe becomes as easy and cheap as sending an email? Banks are being forced to adapt. Some have begun to integrate blockchain rails into their infrastructure. Others have lobbied for stricter regulations. But the trend is undeniable. Stablecoins are offering a superior user experience, especially for the underbanked or those in volatile economies. The geopolitical implications are massive. In the past, economic sanctions were enforced by controlling access to the global banking system. Now, with stablecoins, that control is weakening. Countries and individuals cut off from SWIFT or traditional finance can still participate in global commerce. This hasn't gone unnoticed by regulators. In response, the U.S. introduced the Genius Act in early 2025, a sweeping piece of legislation aimed at regulating stablecoin issuers. The law mandates full transparency of reserves, regular audits, and strict adherence to anti-money laundering standards. While it adds friction for issuers, it also legitimizes the sector and opens the door for large institutions to enter the space. In fact, the Genius Act has had the unexpected effect of boosting confidence in stablecoins. Tether, previously criticized for opaque reserves, now publishes real-time audits and holds over $98 billion in U.S. Treasury securities, making it one of the largest holders of government debt in the world. That's not just a crypto story, it's a macroeconomic headline. A private company, not a nation, is now a major player in global finance, simply because people trust its version of the dollar more than their local currency or even their local bank. Meanwhile, fintechs are leaning in hard. PayPal launched its own dollar-backed stablecoin, PYUSD, in 2023, and by 2025 it's integrated into over 30 million merchant terminals worldwide. Visa and MasterCard now support stablecoin payments natively, allowing customers to spend their digital dollars anywhere traditional cards are accepted. In essence, stablecoins have become invisible. They work in the background, just like fiat, but better. Instant settlement, low fees, and cross-border capability are now expected features of digital finance. Even central banks are taking notes. While many nations have explored central bank digital currencies, CBDCs, they've faced slow adoption and concerns about surveillance. In contrast, permissionless stablecoins have exploded in usage precisely because they operate outside state control. Still, governments are now partnering with private stablecoin issuers to accelerate digital payment infrastructure. The line between private and public finance is blurring. What was once radical is now becoming standard. The DeFi, decentralized finance ecosystem, has also been revitalized by the rise of stablecoins. Lending platforms like Aave, Compound, and newer protocols built on Solana, Ethereum, and Layer 2s now revolve around stablecoin liquidity. Users can earn 4 to 6% APY on USDC or USDT by providing liquidity or staking, far outpacing traditional savings rates. These returns, coupled with transparency and self-custody, make stablecoins incredibly attractive to yield seekers. Even retirees and conservative investors are exploring stablecoin-based income strategies. On the flip side, there are risks. Smart contract vulnerabilities, de-pegging events, and regulatory crackdowns could still threaten the ecosystem. We've seen algorithmic stablecoins like Terra's UST collapse in the past, wiping out billions. That memory keeps investors cautious, but newer models have learned from those failures. Today's leading stablecoins are fully backed, regularly audited, and often over-collateralized. The technology has matured, and so has the market. What's most fascinating about this trend is the philosophical shift. People are no longer asking, can crypto replace banks? They're asking, why do I even need a bank anymore? The frictionless, borderless, and censorship-resistant nature of stablecoins is giving individuals unprecedented control over their money. Whether it's a Venezuelan shopkeeper storing wealth in USDC, a Filipino overseas worker sending money home in seconds, or a New York trader arbitraging yields across blockchains, stablecoins are the quiet engine behind it all. In the big picture, stablecoins are not just disrupting finance, they're redefining it. They are forcing legacy institutions to evolve, empowering individuals across the world, and laying the groundwork for a more open and efficient global economy. We're watching the unbundling of traditional banking, and stablecoins are at the center of this transformation. In a world increasingly defined by speed, transparency, and decentralization, stablecoins offer the liquidity of cash, the utility of software, and the security of cryptography. That's a potent combination, and as adoption continues to soar in 2025, it's becoming clear the stablecoin revolution is not a footnote in financial history, it's the headline.